China is the world's second-largest economy, the second biggest exporter to the United States, and the second-largest foreign holder of U.S. debt. Despite often being underestimated, China wields significant financial power. In response to China's global trade influence, President Trump has implemented aggressive tariffs aiming to curb China's dominance in U.S. markets. The White House has indicated that tariffs on some Chinese goods could reach as high as 245% by January 2025. By the end of April, the average U.S. tariff on Chinese imports had climbed to about 20%, but then surged to approximately 124%, more than doubling the cost for American businesses importing Chinese products. If these tariffs remain, trade between the two nations could eventually grind to a halt. This high level of uncertainty is making it difficult for many businesses to plan effectively. Despite tensions, the economic interdependence between the U.S. and China is undeniable. This spring's tariff escalation caused turmoil in financial markets. President Trump has since expressed willingness to negotiate, signaling a softer tone. Meanwhile, China has also shown interest in resuming trade talks, suggesting that it views the current situation as critical to its economic survival. China has several potential avenues for retaliation. As a significant holder of U.S. Treasury securities, equivalent to about 4% of U.S. GDP, China possesses a degree of influence over American financial markets. Although selling off these assets suddenly could create short-term volatility, such an event would likely prompt intervention by the Federal Reserve. Rising yields on 10- and 30-year U.S. Treasury bonds in April led to higher interest rates for consumer loans, including mortgages. However, most experts believe China has not yet deployed this tactic. The mere perception that China might dump U.S. debt has already had an impact, demonstrating that Beijing may not need to take drastic action to achieve leverage. Investors become jittery when bond markets react, and that alone works in China's favor. In addition to financial tools, China controls about 60% of the global supply of rare earth elements, essential for defense systems, electronics, renewable energy, and automotive technologies. The Chinese government has started placing export restrictions on key materials such as gallium, germanium, antimony, and lithium, all vital to U.S. industries. Replacing these resources from other sources would be extremely costly and logistically difficult. The sharp increase in tariffs has also led to a slowdown at U.S. ports, and a looming supply shock is on the horizon. Some companies are delaying imports and paying higher warehousing fees, while others are shifting their supply chains to alternative countries with potentially more favorable trade terms than China. Nonetheless, Chinese goods remain significantly cheaper than U.S.-made products, thanks to government subsidies and lower production costs. While some U.S. officials argue that Americans can and should rely less on inexpensive foreign goods, many consumers continue to prefer affordable products, contributing to a persistent U.S. trade deficit. Despite tariffs, China's trade surplus with the U.S. remains large, although slightly reduced from earlier levels. Major corporations, such as Apple, have benefited immensely from Chinese manufacturing, often without reinvesting in the communities most affected by globalization. China remains the third largest buyer of U.S. exports, particularly in sectors like energy and agriculture. Yet the Chinese government has already taken steps to limit imports of American goods, instructing state-run firms to avoid U.S. natural gas and delaying orders of Boeing aircraft. If tensions escalate, companies like Tesla could face restrictions that impact both sales and access to crucial parts. China's unreliable entity list is another weapon in its arsenal. It imposes restrictions on companies seen as hostile to Chinese interests, affecting investments and cross-border trade. Sectors like agriculture, particularly in red states, are especially vulnerable. U.S. soybean farmers, who have only recently begun rebuilding trade ties with China following the 2018 tariffs, may face renewed disruptions. Nations affected by the new tariffs are under pressure to strike quick deals with the Trump administration, straining diplomatic relationships built over decades. If these tensions push the European Union closer to China, it could weaken the U.S.'s global standing. America's influence now relies more on historical momentum than current diplomatic goodwill. Just a few months ago, many countries would have sided with the U.S. in a dispute with China. Despite China's often unfair trade practices, America's aggressive and unilateral actions have alienated potential allies. President Xi Jinping has capitalized on this moment, traveling to countries like Vietnam, Cambodia, and Malaysia to rally support against what he calls U.S. unilateral bullying. China has also vowed to retaliate against nations that align with American policies at its expense. Looking back, some argue that admitting China into the World Trade Organization was a mistake. The move enabled China to flood global markets with cheap goods, supported by low labor costs, lax worker protections, and minimal environmental oversight, contributing to the decline of manufacturing in countries like the U.S. Supporters of Trump's tariffs, particularly domestic manufacturers, view these measures as overdue. However, implementing and managing this trade war requires immense resources. Agencies like U.S. Customs and Border Protection may not have the personnel or infrastructure needed to enforce such policies effectively. If the trade conflict drags on, it could lead to more port congestion, slower processing times, and widespread disruption. In the end, the key question is whether the U.S. can realistically achieve its goals within the constraints of its current capabilities.